Well, hi guys, welcome to the special coverage on the RBI credit policy announcement. Of course, we heard the governor, there has been a change in script this time around, although rates have been kept unchanged for a 10 straight time at 6.5%, but there has been a change in stance. Of course, that is being looked upon as a dovish tilt. That is something that we were waiting for quite some time now, and this has finally happened. So the stance has been changed to neutral from withdrawal of accommodation, and the MPC voted 5:1 majority to keep policy repo rate unchanged. Inflation forecast has been unchanged at 4.5% with adjustments to the quarterly figures. Same goes for FY25 GDP growth estimate as well. That has been unchanged at 7.2%, and there have been adjustments to the quarterly numbers as well. But in terms of inflation, the governor has said that you can expect higher inflation in the month of September. And although the inflation horse has been brought to the stable within the tolerance band, governor has clearly said that we have to be careful about opening the gate just yet. So yes, I'm Nandita Khemka, by the way, bringing you this special live coverage with a battery of guests, and we will be decoding the governor's tone as well as the comments on inflation, food inflation, growth forecast, even on NBFCs for that matter. He has given out a stark warning on NBFCs as well. But we will be decoding all those comments with our guests today. So joining me right now is Sunil Subramaniam, market expert, as well as Achula Jethmalani, who's an economist at RBL Bank. Achula, coming to you first. A change in script, much needed, and given the fact that, of course, there was a lot of gloom in the wake of, the raging war in West Asia, there was a pall of gloom, but now this seems to be the much needed good news that the market was waiting for. But first and foremost, change in stance, tone dovish. Here on, we saw the inflation forecast as well. Would you be, relieved that there has been that the governor has given out all these forecasts, but they have been below 5%, even on quarterly basis?
Yes. So we were expecting that there was an outside chance of seeing a change in stance to neutral. And in a 5:1 vote that has actually been delivered, we really need to see which member voted for change in the policy rate front. But given that inflation trajectory, the visibility and the outlook suggests that at least it will be in the 4.5% to 5% range, at least by calendar year 2024, is of course quite supportive and favorable to the fact that we are pivoting to easy monetary cycle from here on. And that's definitely encouraging. Second is, of course, a change in stance to neutral could have meant that we could see policy rates moving on either sides. But given where we stand in terms of growth forecasts and inflation forecasts in particular, it is clear that we are pivoting to softer rates from here on. It is debatable whether we will see the first cut getting delivered in December, or could we see it come through in the month of February. So just like the US Fed, when they focused on employment situation in the dual mandate, governor in a way has indicated that we will be looking at growth aspect as well, given that we are fairly comfortable on how inflation outlook is looking like at this point in time.
Right. Sunil, getting you in as well here, there was a pall of gloom, right, in the market, although we have just about corrected somewhere around 4 to 5% from highs. Of course, this change in stance comes as a much needed relief. Also, the fact that, no fiscal stimulus from China, that's also come as a good news, because yesterday we saw the market snapping out of a 6-day losing streak, and today as well at days high at the current juncture. Do you think we've bottomed out, and here on, would you expect the Nifty to continue its upward trajectory?
Well, that's a very strong call to make. But I think the tone of the RBI's governor's speech, I think, is what the market has very positively taken into account. And while we can't say that a December rate cut is on the cards as yet, but I think that the fact they've shifted their stance to neutral means that they're now supportive of growth, and that inflation is not that big a concern in their mind. And I think that's a very good signal for rate sensitives in the market. So I think to that extent that the rate sensitives will now react positively, will give an overall support to the market. The external factors on China, of course, and the war in the Gulf Those are factors which are going to create short-term volatility. China is especially important for FII flows. But if you look at it, Chinese markets also have corrected now after their run, because it's clear that the stimulus thing is the initial impact of the stimulus, I think, has been seen. But sustainably, India is a much faster growing country than China, and long-term capital should still favor India. So from that point of view, I think even FII investment into the BFSI space will now go up, because, as you know, that's a big part of the index, right? So the 35% of the index is the BFSI space. So any FII positive flow will give a strong boost. So I'm now, with the festival season coming in and consumption demand also going up, and the good news around the Kharif sowing, the soil moisture, I think everything now looks positive. The Gulf tensions, of course, the RBI governor mentioned the Gulf tensions, but we've seen a number of war-related tensions over the last couple of years, which the market had taken in its stride. So for now to think that the market should react very adversely, I think the reaction in the market of the 6 days of losses was more a FII diversion of money to China. And these were short-term FIIs looking at a good opportunity for a short-term bounce back. But the long-term FII capital, I would still say, would be oriented towards India. And India's share in the passive emerging markets index is now equal to China. So I think that there's strong lines of support for the market in the coming weeks. And I think there's good reason to remain optimistic about the market's direction.
Right, Achla, coming to you, you said that there could be a chance of a rate cut either in December or February. So for FY25 cumulatively, what kind of a rate cut trajectory are you looking at? Would you say a 25 basis point rate cut is something that the RBI would look at, or would you stick your neck out and say 50 basis point looks more likely?
No, I think it was the US Fed which struck a 50 basis points cut. In India's rate cut cycle would begin with a 25 basis points is what we are currently working with. The pivot is clear. The pace is also more or less clear that it will be a 25 basis point to begin with. The inflow of data would probably give more clarity whether it would be in the month of December or it could be in the month of February. But the downward revision in inflation forecast.
Right. What are your thoughts on the growth forecast? Do you think the RBI maintaining the growth forecast at 7.2, is correct? Because given the fact that, all the recent indicators like, the IIP data, PMI data, most of them have come in at multi-month lows. So in that sense, sticking to 7.2%, what kind of a message does it really give out? Achla.
Yes. I think that's correct. A lot of lead indicators are suggesting a slowdown in the growth momentum. And in order to attain a 7.2% kind of growth rate for FY25 looks a bit challenging. But I think a lot hinges on how the festive season pans out. And given that there is still resilience in global growth, there is this hope that we may not see a significant downturn in overall economic activity, that per se. Second is monsoons have been pretty decent. Of course, the spatial distribution has been a little skewed, but the Kharif sowing is suggesting that the agri sector outlook is also turning out to be a little more positive. So we could see a 7 to 7.2% still obtainable, but for that we will have to see that consumption does not really take a back seat after the third quarter, which is October to December quarter, jump due to festivities. But I think, yes, it is still looking a little optimistic on the growth front.
What about the inflation projection for the first quarter of FY26, Achla? It has been cut down to 4.3% from 4.4% that was forecasted in the last policy. Your thoughts? Do you think this is reasonable?
Yes, we are still closer to the 4.5% handle when we look at our forecasts, because there really needs a lot of convincing that food inflation will be on a downward trajectory on a sustained basis and not be susceptible to seasonal shocks. Right. So we are a little less optimistic on the headline inflation front, because core inflation has already fallen to where it could have possibly fallen in the handle of about 3.5%. And if it has to converge to the 4 to 4.5% kind of inflation outlook in the next 2 to 3 quarters. We really need to see that the food inflation trajectory starts falling from the 7% handle to closer to 6%, and only then a convergence is possible. So it's great to see that of 4.2 to 4.3% is something that is expected in after the December quarter. But I still think that the concerns around overall food inflation are not completely ruled out. So that's one aspect. But as of now, closer to 4% definitely looks great, especially given in the backdrop of how geopolitical situation is having some spillover effects in commodity prices.
Right. Sunil, coming to you, assuming that there will be a rate cut in December, would you play that with, by looking at PSU banks, or would you play that via private banks? Because, the gap between credit and deposit growth has narrowed significantly. Should the RBI be worried about financial stability? And in that sense, which pocket would you be playing within the banking pack?
By saying, assuming a rate cut, you're taking the words out of my mouth on there is a rate cut or not. I'm not of the view that there's a December rate cut on the anvil. And I'll tell you why. Because the RBI has a 4% target, and no point is he dropping the inflation projection below 4. Number one, whether that 7.2 growth happens or not is not relevant. The RBI governor is saying 7.2. I think the speech of the RBI governor to say that growth doesn't need support, inflation is trending down, though this quarter will be high, we expect down, but it's not still below 4. So I'm not so confident of a December rate cut. So assuming a December rate cut, what would I play is a very hypothetical situation. But PSU banks, I think, are definitely a good play for a slightly different reason, that I expect that the corporate banking shift from the retail to the corporate banking is underway, with private sector corporate capex on the road to pick up. And I think PSU Bank has a larger role to play there. One. Two is the noise around the rate. See, the markets always anticipate things, right? So whether the rate cut happens in December or not, the change in stance is positive for rate sensitive, and their PSU banks with a much larger holding of G-Secs in their portfolio, not only from their SLR, but from their overall excess that they keep, right? They are going to get treasury gains from their holdings of G-Secs, which would ease after this change in stance. So yes, PSU banks are a good pick at this point in time, but I'm more in terms of a rate cut maybe happening in the first quarter of 2025 rather than in December.
Okay, that's the view then. But I just want to point out, that MPC member Nagesh Kumar is the only one who voted to reduce the policy repo rate by 25 basis points. Of course, we have 3 new external members, in the MPC. So the setup has been different, and here only one member had voted for a rate cut. But now coming to NBFCs, there's been a stark warning coming in from the governor, right? Just going through some of his comments, he said that NBFCs have registered impressive growth over the last few years. But, there has been observations that, NBFCs are aggressively pursuing growth without proper administration. And push effect is happening as business targets are driving growth rather than the actuals. So given the fact that there has been this warning, how would you play the HFCs and MFIs, I beg your pardon, in particular? Of course, we have seen the RBI cracking down on NBFCs in the past as well, in the recent past, so to say. So do you think more, such regulatory actions are coming for MFIs, particularly and HFCs?
See, definitely more restrictions would come because RBI is concerned. And what he did mention, I think you got to read between the lines, is the end use of the money. Because he's saying they are pushing the loans. There's no demand, but they are pushing. So what I think he's worried about, and it's stated, is the excessive gold loans. If you see outside of the policy, RBI has already spoken about excessive gold-based lending, right? That's number one. And second is the end use of the money, I think, is getting into the stock market. You see all this F&O trading, retail investment in the stock market. So there is a strong feeling that consumption is not really picking up, lending is picking up. Where's that money going? Is that getting channelized into the stock market? It's an overall thing. So from that point of view, I do expect them, along with SEBI, to have a close view on this space. But look at it this way. The large part of the NBFC sector is outside of the stock market. right? So the listed NBFCs, right, in the stock market are already significantly important ones, well regulated, overseen by RBI. So actually, it's a positive for the listed players in the NBFC space. Is the unlisted players, the small chota mota NBFCs who are there going out pushing aggressively, those are the ones that RBI will come down upon. So from a stock market perspective, I think the good quality NBFCs will actually get a greater market share. They'll get better terms of engagement because of these strictures. So their market position will actually improve. So actually, I look at it as a very positive for the listed NBFCs in the stock market.
Right. Also getting in the discussion, we have Mayuresh Joshi, who's the head of equity research at William O'Neill. Mayuresh, great to have you on the show. Of course, music to the ears for the markets, change in stance to, neutral from withdrawal of accommodation. Much needed reprieve, so to say, after yesterday's uptick. But, the guests on my panel aren't really convinced that we can see a rate cut as early as December. What are your views after listening to the governor's speech?
Morning, Nandita. No, I concur with the other panelists as well. So I think as data points keep on coming in, both locally as well as globally, a large part of the expectations that have now got built in terms of inflation and specifically core inflation remaining stable, unless we see something out of the Middle East which suddenly has a huge spurt in crude prices, which is a large unknown at this point of time. Leaving that aside, I think core inflation is very much under control locally and globally. And as the Fed has started the rate cut cycle, RBI will follow suit in the month of December as well. Apart from that, I think growth and inflation numbers are on track, which has probably buoyed market sentiments as well.
What about the governor's comments on NBFCs? Seems like more regulatory action may be coming for the likes of housing finance companies and MFIs. I seem to be not getting MFIs right today. But, I was just talking to Sunil and he said that it could actually be good news for some of the listed and larger NBFCs. Would you concur with that?
Yes, because I think the larger rated NBFCs, Nandita, go through a regulatory and a compliance framework, which they adhere to very, very clearly. So even if you go through their presentations, you go through their transcripts, they are very, very clear in terms of following policy frameworks, following regulatory frameworks, as well as compliance requirements that are probably needed. So to that extent, all the elements that RBI tries to put in its framework are largely followed by the better rated, larger leadership NBFCs. The lower rated NBFCs, as the governor also pointed out, go into different mechanisms to probably boost their top line growth. And because of that, I think RBI's clampdown in terms of the lower rated NBFCs or the newbies in this space is something that the markets have probably gathered from the statements. And therefore, I think the larger rated NBFCs, the leadership NBFCs, in my opinion, should have no concerns related to how the policy setup and their own regulatory framework within the banking environment is being put up.
Mayuresh, one more question on this entire China issue. Is the China risk out of the way now? Because the stimulus was underwhelming, to say the least. The general consensus now seems to be that it's too soon to really sell India and buy China. Would you also prescribe to that view?
Oh, absolutely. In fact, I think what is really transpired or what is really transpiring in China, even with the huge stimulus, is that it was a need of the hour. There were disinflationary conditions being built up in China, and therefore, I think to have the stimulus put in, expecting discretionary spending going up, and therefore inflation going up in China is something that the banker probably needs. So I think it's more of a monetary stimulus rather than a fiscal one, because I think what has probably happened over the last 10 years in terms of building up a lot of these industries, and because capacity utilization for all these industry building up activities, including your solar panels, solar chips, as an example, are probably getting underutilized. So to that extent, the India trade vis-a-vis China might very well continue.
Right. One last question to Achla, really. With tensions flaring up in West Asia, of course, crude came back to that $80 per barrel mark, right? But it has cooled off slightly. But how much of a risk do you see crude emerge? Because the situation in West Asia is extremely uncertain, to say the least. And from $60, we've once again seen crude hitting $80, right? So what are the chances that you could expect something which goes beyond $85? What are you penciling in terms of a forecast for crude prices?
Yes, I think that has been a very volatile space currently. It's very hard to pin down a forecast because there's not a lot of clarity how the whole geopolitical situation and the landscape will shape up. So as of now, we're still going with the assumption that we will see Brent crude prices come down and hover around the $70 to $75 a barrel the mark. And assuming that there have been no changes in pump prices in the last several months, irrespective of how the crude prices have swung. So really the spillover to consumer prices may still be capped. But having said that, if say crude prices were to stay at around $80 a barrel for another 3 months consecutively, then we could see some bit of inflation build up again. But at this point in time, we are not seeing a major spillover in terms of either significant uh, uh, burgeoning of trade balance for that matter, a higher import bill due to oil, or a large spillover in, say, fuel prices due to higher commodity prices, particularly crude. So as of now, we are hoping that the situation will ease the pain of price rise in crude prices. So.
All right, Achula, with that, thanks a lot for joining in this morning and sharing your thoughts with us. We look forward to touching base with you again sometime soon.
Thank you for having me on the show.
Thank you. Sunil, let me come back to you. How would you be playing the entire OMC basket now, given the volatility in crude prices? Of course, yesterday we saw an almost 5% cool off in crude prices, and we of course saw OMCs reacting to that as well, right? So, given the fact that they have already seen quite a good run, and now there is so much volatility, how would you play the entire basket?
So I would actually say that the crude rose more on fear and tension rather than a supply-demand situation, right? I think that the demand-supply situation is quite comfortable. Saudi Arabia has been trying for a long time to make sure that crude goes up near $100 a barrel. They haven't succeeded. What are the factors behind that? I think is important. The first thing is that I think US is now a big player in the market, and they always act to cool off. There's a US election in the pipeline. They don't want oil prices because in the US, the retail consumers are very sensitive to that. So in any election run-up, the petrol prices at the pump in the US are important. So US will pump more crude and supply the market. So their imports to the extent will come down. Second is Libya is a new factor which has entered the marketplace. And Libya pumping oil is adding to the supply side of the situation. Third thing is just 1 minute if you pause back and look at the fact that the country is fighting the war, the Iran, the Lebanon, right? From that point of view, if they need to fight the war, they need money. So contrary to the fact that they would be pumping less oil, they will pump more oil to get more to finance the war. So supply is not a situation issue. Normally this is a winter and crude prices normally harden in the winter season, but this has been well anticipated. And I think the run up from 60 to 80, I think we'll see a slight pullback. And so from that point of view, my view is slightly contrarian here that crude prices are probably going to stabilize. So to that extent, OMCs, from a refining margin perspective, right, I think are a decent play to play.
Right. Mayuresh, coming to you then, let's also talk about the earnings season that's upon us, right? TCS kicking it off tomorrow. What kind of expectations are you, entering this earnings season with, especially in terms of IT? Because last quarter, we nearly had very low expectations, and it, did spring a positive surprise, the entire IT pack. This time around, are the expectations high? And do you think the reverse to happen?
Not short of the expectations, Nandita, but if you go on a sequential note, it should be relatively stable. Again, what we probably heard from the Accenture management, it seems to be a very stable environment, specifically in North America at this juncture. And again, I think the entire thesis that is getting played out in terms of the rate cut cycle in the US and the core sectors that the IT sector caters to, BFSI, retail, manufacturing, should all start showing signs of stability and the reasonable amount of growth as we hit the next calendar. Along with that, core inflation remaining stable in the European zone as well, which is also one of the key areas for a lot of our large and mid-cap IT companies, seem to be on a very stable footing at this juncture. Last but not the least, I think wage hikes should be taken into stride. Again, quarter three, in our context, where there will be a lot of furloughs because of Christmas holidays, will be taken into stride. And therefore, as discretionary spending patterns evolve in Q4, Q1 in the US context, I think there should be sufficient amount of trends to suggest cloud computing, AI, generative AI, these trends and the investments thereof across businesses should stabilize and accelerate as we head into the next calendar year. From a valuation standpoint, yes, the stocks have moved significantly higher, mid caps even more than the large caps, trading at higher valuations compared to their own mean standard deviations over the last 5 years. Even from a markets with India viewpoint, price action has remained strong. A lot of stocks, specifically in the mid, have moved in late stage basis, and therefore I think earnings are going to be critical. If earnings disappoint for some parts of the IT market, I think those stocks will take a beating. Stocks where earnings remain stable and the outlook from a management perspective remains strong, those stocks might continue outperforming. Having said that, mid cap might continue outperforming large cap Navita at least over the next couple of quarters, because management commentaries in terms of revenue growth, pricing, and order wins have remained stable.
Right. Just want to come to Sunil for one question, and then I'll come to both of you for closing comments. This morning we had a bit of news flow, which is good news for the debt market, so to say. After a period of 3 years on its watch list, the FTSE Russell has announced that Indian sovereign bonds will be added to its emerging markets government bond index. Now, this comes after Indian government bonds were included in JP Morgan and Bloomberg indices as well, right? So, in terms of the gush of liquidity in the bond market, how much of exposure should one have to debt market right now? Sunil, this question to you.
So I would say that buy on the news, sell on the fact, right? The news is now the market. The actual facts are going to happen in 2025 second half, right? So I think this is more of a buy India situation, because this will lead to dollar flows, help RBI's currency management process, help the fiscal deficit, help the undercount deficit. I think overall from a macro perspective, it's good news. I don't see RBI allowing. See, there's one thing about them wanting to buy government bonds and RBI having to borrow overseas. India, among the top 12 GDP countries, is the lowest in terms of forex debt to GDP, right? We tend to borrow more locally. It gives an additional window to RBI. So I would look at this as a very positive macro. Now, from a debt market perspective, the news will be discounted today, right? So if you get in today, there are good gains. But over the period of time, as you approach the actual fact date coming through, these will disappear. So as a short-term call, you want to take a call, yes, good and book profits. But longer term, it's a local demand supply situation which will drive the interest rates here. And foreign debt will not make that big an impact into domestic borrowing rates.
Right. Okay. Now, last question to both of you. It's kind of a poll. I would like you guys to take a guess. By year end, where do you expect Nifty to be? Would it be somewhere around 24 to 25,000? Would it be somewhere around 25 to 26,000, or would you stick your neck out and say 27,000? Because just a week ago or 10 days ago, perhaps, one could say that 27,000 could be a possibility on the index. Of course, now we have a lot of uncertainty in terms of tensions flaring up in West Asia. Of course, we had the China factor, which of course looks like it has abated for now. But if I asked you to take a wild guess, what would you say? Mayuresh, coming to you first.
So, $1 million question, Nandita, I think. But the answer here is that if the macros remain stable and our earnings remain stable, Q2 will be a little bit soft. But if you see commentaries pointing out towards a better Q2 or a better H2, sorry, I think there might be some element of the liquidity which is in the market to recover. So 26,000, not good.
Okay, 26,000, that's your call. But Sunil, what would you say?
I'll say 26,500. I think the other important factor which you didn't mention in today's discussion was the election results yesterday. I think that's given a big boost to to the continuity of the government's policies, reforms. The government has fixed the matter of the NDA in terms of winning elections. And with Maharashtra, a big election coming up next year, this confidence will see through into the market. So I'm slightly saying maybe add another 500 points, maybe 26,500. I stick my neck out a little bit, not all the way to 27 as you would have desired, but 26,500 is where I would put my hat on.
All right, not all that bad then. 26,000 to 26,500. That's the range where the Nifty may end the year. But with that, of course, gentlemen, I would like to thank you for taking out time and joining in on this special coverage on the RBI credit policy. Look forward to interacting with you guys on our shows again sometime soon. But thanks a lot for joining in and sharing your thoughts with us. Well, on that note, of course, we've come to the end of this special coverage on the RBI credit policy. Of course, the stance has changed to neutral. That's something that the markets have really welcomed. We saw the Nifty crossing that 25,200 mark, the Nifty Bank Index as well, picking up smartly, after starting the day on a positive note. But yes, we did see the Nifty Bank Index also crossing that 51,500 mark. So good news, and dovish tone struck by the RBI. There has been a change in script this time around, and the markets are really liking it. But with that, it's a goodbye from me and the entire team that put this coverage together. Thanks a lot for watching. But you guys stay tuned to Money Control for all your other news and updates.